Hey there, it's Merv from Harmony Music. Jammy asked me to do him a favor and explain T accounts for revenues and expenses. I guess he thinks I'm an underused character or something. Whatever, I'm happy to help. You probably already know that assets increase with a debit and decrease with the credit. You probably also know that liabilities and capital are the opposite. They increase with the credit and decrease with the debit. So let's talk about revenue and expenses. When you earn revenue, like with sales or service revenue, it increases with the credit and decreases with the debit. Expenses are the opposite. All expenses increase with a debit and decrease with a credit. It's probably also a good time to mention something called the normal balance. Each type of account has a normal balance, which is the side used to increase. Cash is an asset, which increases with a debit, so the normal balance for cash is debit. All other assets have a normal balance of debit as well. Liabilities increase with a credit, so the normal balance for liabilities is credit. The normal balance for capital is credit. The normal balance for revenue is credit, and the normal balance for expenses is debit. This doesn't mean that these accounts will always have a balance on the normal side, but they usually do. I hope this helps. Why don't you try doing T accounts to figure out the balance of Jammy's revenue and expense accounts? This will give you a good idea of how much money he earned this month through sales and how much he spent on different categories and overall. Having this data will be a great way to see if Jammy is profitable. Let's hope so.